Imagine waking up tomorrow morning, grabbing your coffee, checking your phone, and seeing that you earned $400 overnight. Not from working overtime, not from a side hustle, just money that showed up in your brokerage account because you own things that pay you for owning them. That's passive income. And before you roll your eyes thinking this is some get-rich-quick fantasy, let me tell you something that changed how I think about money forever. There are people right now, regular people with regular jobs, who've built income streams that pay them $1,000, $2,000, even $5,000 every single month without lifting a finger. They're not geniuses. They're not lucky. They just figured out something most people never learn. There are investments specifically designed to put cash in your pocket on a regular schedule. And once you understand how they work, building your own income machine becomes surprisingly straightforward. Today, we're going to build one together. I'm going to show you exactly how to create a diversified, passive income portfolio using bonds, dividend stocks, REITs, and some instruments you've probably never heard of. We'll talk real numbers, real yields, and real strategies. By the end of this, you'll know exactly how much money you need to invest to generate whatever monthly income you're dreaming about. So let's get into it. First, we need to understand what passive income actually means in the investment world. Passive income is money that comes to you regularly from investments you own, without actively doing anything to earn it. When you buy certain investments, they pay you just for holding them. It's like being a landlord who collects rent, except instead of dealing with broken toilets at 2 a.m, your investments just send you cash. The 3 main sources we're focusing on today are dividends from stocks, interest from bonds, and distributions from REITs, which stands for Real Estate Investment Trusts. Think of REITs as a way to collect rent from hundreds of properties without ever being a landlord yourself. Here's what makes this exciting. Right now, in early 2026, we're living in what financial people call a golden age for income investors. The yield on a 10-year Treasury bond, which is basically the interest rate the U.S. government pays you for lending them money, is sitting around 4.25%. That might not sound thrilling, but historically that's actually really solid. For context, back in 2020 and 2021, that same Treasury bond was paying less than 1%. So if you're looking to build passive income, the timing right now is favorable. Let's start with the foundation of any passive income portfolio: bonds. A bond is essentially an IOU. When you buy a bond, you're lending money to someone, either the government or a corporation, and they promise to pay you back with interest. The interest payments you receive are called the yield, which is just a fancy word for the percentage return you earn each year. Think of yield like the interest rate on a savings account, except bonds typically pay more. The safest bonds in the world are U.S. Treasury bonds because they're backed by the full faith of the United States government. Unless you think America is going to collapse, these are about as safe as it gets. Right now, Treasury bonds pay around 4 to 4.25% depending on duration. But here's the thing about buying individual bonds. It's complicated. You have to figure out when they mature, which means when you get your original investment back, and you have to manage multiple bonds with different expiration dates. This is where bond ETFs come in. An ETF, or exchange-traded fund, is basically a basket of investments wrapped into one thing you can buy like a stock. Instead of buying one bond from one company, you buy a bond ETF and instantly own pieces of thousands of different bonds. The fund managers handle all the complicated stuff, and you just collect your interest payments. The 2 giants of bond ETFs are BND and AGG. BND is Vanguard's Total Bond Market ETF, and AGG is iShares Core US Aggregate Bond ETF. Both of these hold over 10,000 different bonds, including US Treasuries, mortgage-backed securities, and investment-grade corporate bonds. They're both dirt cheap to own, charging only 0.03% in annual fees, which means for every $10,000 invested, you pay just $3 per year. Both currently yield around 4.1%. Put $100,000 into either fund, and you'd collect roughly $4,100 per year in interest, or about $340 monthly. Not life-changing money, but it's stable, relatively safe, and requires zero effort. There's also something called I-bonds, savings bonds you buy directly from the Treasury Department. Right now, I-bonds pay 4.03% and they adjust for inflation. The downside is you can only buy $10,000 worth per person annually, and you can't sell them for the first 12 months. But as a piece of your overall income strategy, they're worth considering. Now let's talk about the real workhorse of passive income portfolios: dividend stocks and dividend ETFs. This is where things get exciting because you can actually earn more than bonds while maintaining reasonable safety. A dividend is a portion of a company's profits that gets paid out to shareholders. Not every company pays dividends, but many established, profitable companies do. Think of it like owning a tiny piece of a business and getting your share of the profits every quarter. The problem with picking individual dividend stocks is putting all your eggs in a few baskets. What if you buy stock in a company that seems stable and then they cut their dividend? That's why smart income investors use dividend ETFs, which own dozens or hundreds of dividend-paying stocks at once. If one company cuts its dividend, you barely notice because you own so many others. The king of dividend ETFs is SCHD, the Schwab US Dividend Equity ETF. This fund has become wildly popular, with over $70 billion in assets, and for good reason. SCHD doesn't just buy any stocks that pay dividends. It specifically screens for companies with strong financials, consistent dividend histories, and the ability to keep paying and growing those dividends over time. The result is a portfolio of about 100 rock-solid companies like Merck, Cisco, Amgen, and AbbVie. Currently, SCHD yields about 3.8%, actually higher than Treasury bonds. With $100,000 invested, you'd collect around $3,800 per year, roughly $317 monthly. And unlike bonds, where your principal stays flat, dividend stocks can grow in value over time. So you could end up with more income and a bigger portfolio. Another excellent option is VYM, Vanguard's High Dividend Yield ETF. This fund casts a wider net, holding over 560 stocks compared to SCHD's 100. The yield is slightly lower at around 2.4%, but you get more diversification, and VYM has actually beaten SCHD in total returns over the past few years. It charges the same rock-bottom fee of 0.06%. Now here's where we start getting into higher yields, but I need to warn you. Higher yields always come with higher risks. It's a fundamental law of investing. When something pays you more, there's always a reason. Either it's less safe, more volatile, or there's some other trade-off. Keep that in mind as we explore these next options. Let's talk about REITs, one of my favorite passive income tools. A REIT, or Real Estate Investment Trust, is a company that owns, operates, or finances income-producing real estate. By law, REITs have to pay out at least 90% of their taxable income to shareholders as dividends. This legal requirement is why REITs typically offer much higher yields than regular stocks. When you buy a REIT ETF, you're essentially becoming a landlord without the hassles. You own pieces of shopping centers, apartment buildings, hospitals, data centers, cell towers, and warehouses. Tenants pay rent, and you get a piece of it. The biggest REIT ETF is VNQ, Vanguard's real estate ETF, with about $34 billion in assets. It holds over 150 REITs across every property type imaginable. Healthcare REITs that own hospitals and senior living facilities. Industrial REITs that own warehouses where Amazon stores packages before they arrive at your door. Data center REITs housing the servers powering the internet. VNQ currently yields around 3.9%, similar to SCHD, but from a completely different source. This is crucial for diversification because real estate doesn't always move in the same direction as the stock market. Here's a tax tip most people miss. REIT dividends are usually taxed as ordinary income rather than qualified dividends, meaning they're taxed at your regular income rate. This makes REITs especially well suited for tax-advantaged accounts like IRAs or 401s where you don't pay taxes on income until withdrawal. Or in Roth accounts, never. On the other hand, qualified dividends from stocks held more than 60 days get preferential tax treatment at rates of 0 to 20% depending on your bracket, much lower than ordinary income rates. This is why smart investors put their REITs and bonds inside retirement accounts while keeping dividend stocks in taxable brokerage accounts. Now let's venture into territory that might be new. Covered call ETFs. These are among the highest yielding funds available to regular investors, often exceeding 7 or 8%. But they work very differently than traditional dividend investments. A covered call is an options strategy. Imagine you own a stock. Someone says, "I'll pay you $50 right now for the right to buy your stock at $120 anytime in the next month." If the stock stays below $120, you keep the $50 and your stock. If it goes above $120, you have to sell your stock at that price. The $50 you collected is called the premium, and it's immediate income in your pocket. Covered call ETFs do this systematically across hundreds of stocks, generating substantial premium income passed along to shareholders. The trade-off is you give up some upside potential. If the market surges, you won't capture all those gains because some stocks get sold at the call strike prices. But in exchange, you get fat monthly income checks regardless of what the market does. The most popular covered call ETF is JEPI, JP Morgan Equity Premium Income ETF, with over $40 billion in assets. JEPI holds a portfolio of defensive, low-volatility stocks from the S&P 500 and sells covered calls on the index. The result is a yield of around 7 to 8%. With $100,000 in JEPI, you're looking at $7,000 to $8,000 per year, or roughly $600 to $670 monthly. That's real money. JEPI also has a sibling called JEPQ, which does the same thing with NASDAQ 100 stocks, meaning more technology exposure. The yield is even higher at around 9 to 11% because tech stocks are more volatile, generating bigger option premiums. But the trade-off is more volatility in your portfolio value. Let's put this all together and build actual portfolios. Here are 3 models depending on your income goals and risk tolerance. Model 1. The Safety First Portfolio. Allocation: 40% bond ETFs like BND, 30% dividend ETFs like SCHD, 20% REIT ETFs like VNQ, 10% Treasury bills. Blended yield: approximately 3.5 to 4%. With $200,000 invested, you generate $7,000 to $8,000 yearly, about $580 to $670 monthly. Solid and dependable. Model 2. The Balanced Income Portfolio. Allocation: 30% Dividend ETFs split between SCHD and VYM, 25% Bond ETFs, 20% REIT ETFs, 15% Covered Call ETFs like JEPI, 10% Treasuries for stability. Blended yield, approximately 4.5 to 5%. With $200,000, you generate $9,000 to $10,000 yearly, $750 to $830 monthly. Model 3. The Maximum Income Portfolio for Aggressive Income Seekers. Allocation: 30% Covered Call ETFs split between JEPI and JEPQ, 25% REITs, 25% Dividend ETFs, 20% High-Yield Bond ETFs like SPHY. This fund holds junk bonds, bonds from less creditworthy companies that pay higher rates to compensate for higher default risk. Yield could reach 6 to 7%. With $200,000, you're looking at $12,000 to $14,000 yearly, $1,000 to $1,160 monthly. But understand, this portfolio will be more volatile, and in a market crash, you could see significant drops in your principal value. Let me show you numbers at different investment amounts using the balanced portfolio at 4.5% yield. With $50,000 invested, you'd earn about $2,250 yearly, $187 monthly. With $100,000, $4,500 yearly, $375 monthly. That could cover a car payment. At $250,000, $11,250 yearly, $937 monthly. At $500,000, $22,500 yearly, $1,875 monthly. That could cover rent in many areas. At $1 million, $45,000 yearly, $3,750 monthly. For many people, that covers basic living expenses. The harder part is accumulating enough money to generate meaningful income. Here's a realistic path. Invest $500 monthly in a portfolio averaging 7% total returns. After 10 years, you'd have approximately $87,000. After 15 years, $174,000. After 20 years, $310,000. At $310,000 in a balanced portfolio yielding 4.5%, you'd generate nearly $14,000 yearly in passive income, over $1,100 monthly. You went from zero to over $1,000 monthly just by consistently investing $500 for 2 decades. That's the math that changes lives. You could accelerate this timeline by increasing your savings rate as your income grows. Every raise, every bonus, every tax refund, throw it into the passive income machine. You could start a side hustle specifically to fund your investment account. Whatever you earn on the side goes straight to buying income-producing assets. The more you shovel into the machine early, the faster it grows thanks to compound growth, which is essentially your returns earning their own returns. Let me address common mistakes. First, chasing yield without understanding risk. When a fund pays 12% while everything else pays 4%, there's a reason. Either significant credit risk, leverage amplifying returns and losses, or strategies sacrificing growth for income. Second, putting all income investments in taxable accounts. Bonds, REITs, and covered call ETFs belong in tax-advantaged accounts. Put qualified dividend stocks in taxable accounts where they enjoy lower tax rates. Third, ignoring total return. A fund yielding 3% but growing 10% annually beats a fund yielding 7% that never grows. Fourth, not diversifying income sources. Spreading across different asset classes provides stability that single-source income cannot. Building passive income isn't really about the money itself. It's about freedom. Freedom from being completely dependent on your job. Freedom to take career risks because you have a financial cushion. Eventually, freedom to stop working altogether if you choose. Most people spend their entire working lives trading time for money. Their income requires their presence. Building passive income breaks that cycle. You build assets generating income whether you're at your desk or sleeping in on a Tuesday morning. Start with whatever you can. Even $50 monthly into a Dividend ETF is building your future passive income. Every dollar invested is a tiny worker earning you money while you live your life. Over time, you hire more workers. They start earning enough to hire more workers themselves. Before you know it, you have an army generating income around the clock. That's the real secret of wealth. Rich people don't just earn more money. They own things that make money for them. That's what we've built today. A blueprint for owning things that make money for you. Bonds paying interest, stocks sharing profits, real estate paying rent, options generating premiums. The passive income machine is real. The tools are accessible to anyone with a brokerage account. The only question is whether you'll start building yours today or keep putting it off until tomorrow. Start now. Start small if you have to, but start. Your future self, the one waking up to find money that appeared in their account overnight, will thank you for it. The mechanical process of setting this up is surprisingly simple. Open a brokerage account at a major firm like Fidelity, Charles Schwab, or Vanguard. All offer commission-free trading on ETFs. Transfer money in. Buy the ETFs in whatever allocation you've chosen. Set your dividends and interest to either reinvest automatically if you're still building wealth or deposit as cash if you want to spend the income. That's it. Once it's set up, your passive income machine runs itself. The hardest part isn't the investing itself. It's having the discipline to keep feeding the machine month after month, year after year, until it grows large enough to genuinely change your financial life. But if you can do that one simple thing, the math will handle the rest.